This video is going to look at trend following versus counter trending. We're going to explain a little bit about each of these different approaches, and then we're going to compare the two, running through both the pros and the cons of each with the use of a few examples. Hello, I'm Peter Martin with Trading 212, and we add educational videos about trading to YouTube regularly. If you click on the subscribe button and the alarm bell icon, then you'll get a notification whenever we add a new video and you won't miss out. Well, trend following and counter trending are two different approaches to trading the financial markets, and basically they're the opposite of each other. With trend following, a trader attempts to profit by aligning themselves with sustained directional movement of the market that might last, let's say, a few months, and they would attempt to hold on to this trade for as long as possible, only exiting after the market reverses significantly, let's say for a few weeks. So let's look at an example now to illustrate this a bit further. So here's a quick example to illustrate how a trend follower might approach trading the markets. We've got a price chart, price plotted against time, and we can see that with the power of hindsight, this market has been trending. Overall, there is a net upward movement in the price. And the way a trend follower might approach this is to see these new highs being set here, say, or here, or even up here. And using whatever method of analysis they have, they might get a signal to buy. So they might go long there or say here. And then they would hold onto their position as long as they felt the market was trending. And so we see if they hold their position from there, they went long there, and here's where the market currently is, then this is their profit that they're sitting on. Counter trending, as we said before, is basically an opposite approach. Rather than trading in the direction of the market when it rises to a new high or falls to a new low, a counter trender will seek to oppose the direction. So going short when they see the market rise to a new high, or buying when they see the market fall to a new low, in the hopes that these new highs or lows do not herald the start of a new trend, and basically counting on the phenomenon of support and resistance, hoping that the market will reverse its direction after a new high or new low. So let's look at an example of this to illustrate this a bit further. So a quick example of how a counter trender might approach trading the market. A different price chart this time with slightly different market conditions, more range bound, and that's because a counter trender who takes basically an opposite approach to trend following, as we said before, will be appropriate in these kind of conditions. So a counter trender might look at this high here and say that's my reference point for the market being expensive. If I see the market draw close to that, I'm going to go short and look at this low here and say, okay, that's my reference for where the market is cheap, and I'm going to buy if the market draws close to that. So at this point here, we see it approaching close to that previous high, and the counter trender takes a short position. When the market does indeed change direction, as it draws close to that low from before, they close out their position, taking some profit, and they square and reverse. So they go long the market at this point. And once again, as the market approaches previous high, they close out, taking some profit, and they take a short position. And we can see at this point, the market actually pushes up through the high, and they're going to be running a loss at this point here. What they might do is to double up, take another short position there, or they might just sit holding the original position. And we can see that this time they get out of jail as the market comes back down. It doesn't create a new trend breaking higher. It comes back down and they are sitting on a profit at this point. Now, there's nothing right or wrong about either of these approaches. They can both be made to work, and each has their own pros and cons. So let's look at these now. So a run through of the pros and cons for trend following. Pros are basically one big pro, which is that it has the potential for strong returns. Trends can be sustained and substantial, resulting in very big market moves. And if you're the right way round with those market moves, then that offers the potential for strong profits. And why doesn't everyone do this then? Well, because it's difficult to implement successfully because of these numerous cons that we have listed here. Now, first of all, it requires deep pockets. If you don't have substantial funds behind you, then it does substantially increase the chances of going bust. New highs and new lows don't often actually result in major trends, so that you get a high percentage of losing trades from the numerous false signals you're going to get when the market actually doesn't trend and reverses. Overall, these should be outweighed by the substantial returns that you make, but still this is psychologically tough. You need a strong mindset to pull this off because of that high percentage of losing trades, but also because of the substantial drawdowns where you give back parts of your profits when you have to sit through losing periods, sitting on running losses at times, and also particularly at the end when a trend breaks down, it can be very tough psychologically, as we'll see with this next example. So one of the great difficulties with trend following is managing the end of a trend. And we can see a price chart here once again, and we can see that the market was sort of range bound a little bit in this period. And it's when we got this new low being set here that the trend follower might go short. And we can see that the market conditions were great for that. It fell pretty sharply. They would have been sitting on a nice profit all the way down to here. But a trend follower doesn't just close out at the first sign of trouble, because if they had, they'd be closing out maybe here or here. They need to hang on to their position for as long as possible. So even when the trend bends at the end, then you hold on for a bit and you end up giving back quite a lot of your profit before you exit. And it might be at this point or even higher that they realize the trend is over. And so we can see that they've given back a substantial portion of their overall profit with the bend that happens at the end. So those are the pros and cons for trend following. Let's look at the pros and cons for counter trending. So running through the pros and cons for counter trending, the pros are pretty much the opposite than we had for trend following. And that's where we get a higher percentage of winning trades. And that's because, as we said before, new highs and new lows don't often result in long and enduring trends. The phenomenon of support and resistance is frequently observed, which means you get this higher percentage of winning trades. And that, of course, is psychologically less challenging, having that high percentage of winning trades. But also, humans, generally speaking, tend to be more inclined to follow this process of selling into expensive prices and buying into cheap prices. We tend to find that fairly easy to follow, as opposed to the opposite that we do with trend following, when we're buying expensive prices and selling cheap prices. And relatively speaking, compared to trend following, there's a higher frequency of trades that you tend to put on, and that means banking frequent small profits. Now, you need to be careful though that you don't come unstuck because of these cons. It does require careful risk management. You have to make sure that you're able to get yourself out on those infrequent occurrences when a new trend does form, because if you don't, then it has the potential for you to end up on the wrong side of a trend, at which point your loss is going to be substantial. It's going to be the equivalent of those large profits that a trend follower makes in those circumstances, and that would outweigh all your frequent small profits. Well, I hope you enjoyed this comparison between trend following and counter trending. If you did, please take a moment just to hit the thumbs up button and give us a like, or why not let us know which approach you like best. Give us your thoughts on the subject by sending us a message in the comments section. We do read each one. But that's all for now from me, Peter Martin, and Trading 212. Thanks for watching. I'll see you next time. Goodbye.